Okay, should be back. I'm back studying again. I just slept for like 7 hours. I don't know how, but yeah. Okay, shit. Right now. Okay, let's there is 3 more material, 4 more actually, so 4, 5, 6, and 7. So let's go. Next, it is gonna be analyzing statement cash flow. So yeah, let's go. Okay. Analyzing statement of cash flow number 2. Analyze and interpret both reported common cash flow statement. Cash flow analysis begins with an evaluation of the firm's source and use of cash from operating, investment, and financing activity. Source and use of cash change as the firm moves through its life cycle. Positive operating cash flow can be generated by the firm running related activities. Operating cash flow also provides a check of the quality of firm earnings. Yeah, if earning goes up but cash flow stay consistent, that means it's like the quality of earnings with us, basically. The stable relationship of operating cash flow and net income is an indication of quality earning. I don't know. Does it make sense? Does it make sense for a good company to have good correlation, have a high correlation between earning and cash flow? I still have the matcha, by the way. I don't like it. Next time I'm not gonna buy it. Maybe it's like from tomorrow as well. Tomorrow is not the best, but it's decent enough. Yeah. Okay. The source and use cash of unless and interpret both report and common cash flow statement. The source and use of cash flow investing activity should be examined. Increasing capital expenditure, the use of cash is usually indication of growth. Finance activity section of cash flow reveal information about whether the firm is generating cash flow by issuing debt or equity. It also provide information about whether the firm is using cash to repay debt, reacquire stocks, or pay dividend. Common sense analysis can also be used to analyze cash flow statement. Analysis and both net income and what's OF? Begin negative, depicting net loss and negative operating flow. At the beginning of the growth, net income becomes positive while OF is still negative. Operating finance? Because like in the grocery, I know that operating finance is like negative, but net income exceed operating cash flow until the stage of the maturity when operating finance exceed net income. Both net income and operating finance flow remain positive until the late stage of the decline, when both negative become negative again. Okay. Is this the same as the last slide? Okay. Okay. Analyze and interpret both reported and common size cash flow statement. Operating cash flow has decreased as perspective of revenue. Operating cash flow has decreased as a percentage of revenue. This appears to be due to large accumulation, and operating cash flow has decreased as a percentage of revenue. This appears to be due to accumulated inventories. Investing activities, specifically purchase of plant and equipment, have also required an increasing percentage of the firm cash flow. These observations are consistent with a growing firm. But an analyst should inquire whether the increase in inventory was intended or unintended. Operating cash flow has decreased as a percentage of revenue. Cash flow from operating cash flow has decreased as a percentage of revenue. Oh, all of this is divided by revenue. Oh, okay. As they buy, wait. Why do cash flow goes down when the inventory goes down? Revenue. What's the revenue? I cannot see. Okay, no, accumulating inventory. Because inventory goes up. That's because inventory goes up. Right? Yeah, like I said, inventory goes up. That means the percentage of asset goes up. Right? So that's why. Okay. And most of it is quite stable. Okay, yeah. So inventory. Okay. This appears to be due to logic. Okay. Investing activities, specifically purchasing of plant and equipment, have also required an increasing percentage of firm cash flow. Just of plant and equipment, cash flow from fixed asset, investing cash flow. Okay. It's not that huge, but these observations are consistent with the growing firm, but an analyst should inquire whether the increasing in inventories was intended or unintended. Free cash flow is a measure of cash that is available for discretionary purposes. Cash flow that is available once the firm has covered its capital expenditure. Capex. Okay. What is the formula of Capex? I think Capex is really important. But I don't get really get it why is that important. I've read Capex. If a company generates 10 million in cash flow operation but has to spend 9 million every year just to replace old machinery to stay competitive, owner only actually sees 1 million. The valuation trap. If you value the company based on 10 million, you would be massively overpaying. Capital, I don't really know. In the CFA curriculum and financing model, CAPEX, capital expenditure, is referred to as fixed capital investment. Okay, fixed capital investment. It represents the cash a company spends to acquire, upgrade, and maintain long-term physical assets like property, plant, and equipment. PPE. Depending on the data available in the financial statement, there are two primary ways to calculate it. This is the most direct way to calculate CAPEX. If the balance sheet provided gross for depreciation figures. So ending gross PPE, beginning gross PPE, gross cost of asset. So if you're looking for total new added cost added, so ending minus beginning, okay. In your material, ending gross PPE was 85,000 and the beginning is 60. Since no PPE was sold, gross of cold is just minus. Okay, so it's 25 capex. The net capex method. Since many balance sheets only show net PPE, after accumulated depreciation, you must add back the non-cash depreciation. Net book value and equipment. Why capex is critical for your analysis, as we discussed regarding Warren Buffett and free cash flow for the firm. To firm, capex is in the price of a company pays to stay in business. Grossing that an increase in capex usually an indication that firm is expecting future growth. Free cash flow implies capex is direct drain on your cash. To calculate free cash flow or FC, you must subtract this fixed capital investment from your operating cash flow. Net income, depreciation, amortization. Yeah, depreciation amortization, so non-cash charges. Average annual capex. You want to know how much actual spendable cash an owner can pull out of the business at the end of the year without hurting its operation. The difference between his formula and free cash flow you see is new slide come down onto perspective and business quality. Why do no interest add back in your chef material? Free cash flow to firm. Formula add back interest adjusted for taxes. It's not the firm, it measures cash available for everyone, both bondholder and stockholder. Since interest is what you pay bondholder, you add it back to the CD or total pool. Owner earning is for the owner. Buffett is an equity investor. From his perspective, interest is mandatory obligation to a third party to bank. It is cash that is gone and cannot be spent by the owner. The logic: if you pay the bank before you can buy a sandwich, the interest money isn't part of your earning. You notice that many simplified version of business and depreciation capex seems to skip working capital investment. There are two reasons for this. It is actually there, the maintenance rule. If a business requires additional working capital to maintain its competitive position, the amount must be subtracted just like capex. However, often the group is called to required inventory category. The asset light, for instance, looks for great business companies like Sea Candies or Coca-Cola. These companies often have negative working capital. They get paid by customer immediately but pay supply later. Yes, chef. Oh, big increase. If a company requires massive growing pile of inventory just to stay in the same place, usually considered is a bad business and avoids it. He prefers a company where working capital investment in inventory is so small or efficient that it doesn't significantly eat into cash. Free cash flow is a measure of cash that is available for discretionary purposes. Cash flow that is available once the firm has covered its capital expenditure. Two of the more common measures are free cash flow to the firm, free cash flow to equity. Free cash flow to equity. Net income, non-negotiable. Bro, this is the same fucking slide. You spotted the fundamental technical divide between standard financial analysis and Buffett's school of value investing. While free cash flow to equity and honest earnings both aim to measure what is left for the shareholder, they disagree on whether the borrowed money count as available cash. The primary difference between the FCFA includes net borrowing, while honest equity does not. Here is the breakdown why that distinction exists. In this framework, net borrowing, debt issued minus debt repaid, is added back because it represents cash inflow that is technically available to be distributed to the shareholder. If a company takes out $100 million loan and puts it back in the bank, the company now has $100 million cash that could theoretically pay out as dividend. Today, the goal FCF measured the total immediate liquidity available to shareholders, regardless whether the cash comes from operation or the bank. The Buffett perspective economic reality. Okay, makes sense. Warren Buffett honest equity ignores net borrowing entirely. The Buffett earning must be generated by the business itself, not its ability to go into debt. The logic: the borrowing money is not earning money. If you have personal salary of $5,000, but you use the credit card to get $2,000, you haven't earned $7,000. You only earn $5K. The rest is just temporary transfer of cash that is eventually have to pay back with interest. Yeah. The goal of honor and measure the sustainable economic performance of the business. Buffett want to know how much cash the business machine creates on its own. What the difference leverage is, the difference between this number tells you a lot about how company is being managed. If FCFE is bigger than honor earning, the company is using debt to fund its dividend. Yeah. This is common leverage buyouts, or companies aggressively return capital to shareholder using cheap debt. The company is using its own profit to pay down debt. While this makes the immediate cash flow to equity looks lower, it makes the company safer in the long run. Okay. Are there other formula that Buffett use other than This is so interesting. So he used something called honest equity. Sorry, honest earning, which is equals net income. I forget the whole formula. Depreciation, amortization minus I'm just gonna use what the fuck is FC? Fuck. FC is I forgot what the fuck is name. Okay, I'm just gonna type it because it's my. So return on equity, which is net income. Wait, there's also a CFO. Cash flow operation, and cash flow operation minus fixed cost inventory. No, it's not fixed cost. This is not fixed cost. I forget. Right. It is capex basically. Annual capex. Right? Okay. Net income. Um, Return on equity. Yeah, income equals there has to be the formula. It's not like that, right? I'm pretty sure. Net income divided by owner's equity. What is it? Oh, net income. Oh, and cash flow. Yeah. And then cash ROE. And then CFO divided by owner's equity. Plus, okay. I don't know the fuck it's called. Yeah. Debt to equity and coverage ratio. What is coverage ratio? So debt shareholder equity. What is coverage ratio? I forget. Coverage ratio. EBIT divided by interest expense. Interest coverage ratio. EBIT interest expenses. Earning before interest and taxes, interest expenses. I need to learn that. Dividend reinvest ratio. Okay. Calculate the and interpret the free cash flow from the firm, free cash flow to the equity, and performance and coverage cash flow ratio. Free cash flow to the firm FCFF is cash available to all investors, both equity and debt holder. Yeah. Let's see. Fixed capital investment. Yeah. Fixed capital investment and working capital investment. Calculate and interpret free cash flow to the firm, free cash flow to the equity, and perform coverage cash flow ratio. Free cash flow CFO, free cash flow investment, and net worth. Okay. Free cash flow. Using the financial statement to extract present tax, calculate the company free cash flow and free cash flow investment, assuming tax rate is 40%. So the free cash flow to firm is equal operating cash flow. Okay, so operating cash flow. So I'm just gonna use that. So operating cash flow plus NCC, non-cash charges, minus minus gains plus losses, minus percentage of asset, overall asset, plus percentage of liabilities, right? Okay, so operating cash flow is there. It's 50,000. Then depreciation, increase in theft and loss in disposal of PPE, gains some sales as land. Oh, non-cash charges, so 43,000 minus gains There is no gains, so I'm just gonna remove this. What's the interest? Interest paid, cash paid, interest in payable. Fuck, okay. Bener gua 50k. Why is there no? Oh, because NCC has already been calculated there. I don't know this. Langsung interest aja. Hmm. It just rained today. If you can hear rain, sorry. It's gonna be quite loud rain.
じ不協和音が最高のスパイスになる誰かと共に描く未来の地図一人じゃ描けない鮮やかな景色 yeah, 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 yeah ぶつかり合って生まれる新しい価値人間関係の楽しさが世界を得るってか失敗した線も君が書き換えるこれはこれでありって笑いながら完璧を目指す4連歌を楽しむその柔軟さが僕の心を焦かした社会という大きな壁に僕らの印を小さくても確かに残していく誰かの目に留まるその日を夢見て今日も二人秀を走らせる Express yourself let the colors flow 君とのセッション止まらないフロー壁をキャンバスに夢をグラフィティ二人で作る新しいシティ Red for the passion Blue for the soul 混ざり合って目指す一つのゴール一人の才能限界超えて二人のアート世界へ向けて yeah, yeah, yeah. 世界なんて誰にも決めさせない僕らの感覚を信じ抜くだけ、誰かと共に描く未来の地図一人じゃ描けない鮮やかな景色、yeah, yeah, yeah. ぶつかり合って生まれる新しい価値人間関係の楽しさが世界を彩っていく、yeah, yeah. 次はどんな色で僕らを驚かそうか僕らを驚かそうか長い付き合い今更語ることもないはずなのに夜は深まってゆく不幸の方向失敗の口全部飲み干して氷を鳴らすお前がいてくれたから今日まで来れた言葉にすると少し照れくさいけれどこのチンバムさえもう信頼の中背中で語り合える僕らのスタイル
Property plan and equipment.知り尽くしているだからこそ優しくなれる時があるお前らしいなって笑うその顔何よりの僕の肯定になると愛の幻想忘れさせてくれるこの隠れ家僕らの聖域明日の活力ここでチャージしてまた戦場へ戻ってくんだ Amber liquid deep talk classy night お前との絆最高の light just reflect it the soul base moves the heart 二人の物語 never apart years pass by we grew up wise お前の瞳に映る俺の rise old fashioned way keeping it true 感謝してるぜ my friend to you 変わらないもの変わりゆくもの全てを受け Okay. Next is intangible asset and long-term liabilities and equity. What the fuck is this shit? Now, actually, I'm not gonna go to next material. I actually wanna watch a video by the plain bagel. There you go.
Visit the link in the description below to sign up for their daily newsletter today. Ladies and gentlemen, welcome to The Plain Bagel. I'm your host, Richard Coffin. Today's video is a bit of a peek behind the curtain to show you how the bagels are made and discuss my own investment research process as a investment analyst. I've had this requested quite a few times over the years, given that I work as a portfolio manager / investment analyst for my day job, and I figured, what the heck, I would cover things at a high level, go through my general step-by-step process, and it's not a very formal one. I do change things up every now and then, but hopefully people who want to go through this process themselves find a bit of value in it. Now, a few notes before we get started. Firstly, this isn't a recommendation that people should necessarily stock pick or do their own stock research. I think most people are better served putting their efforts elsewhere, either hiring a professional or just investing passively. Countless studies have shown just how difficult it is to beat the market with stock picking, so unless you're passionate about researching stocks, you'll probably find this all very boring and strenuous, and no guarantee of strong performance. And secondly, while this is obviously my own research process, there are different ways to research a stock. There's technical analysis, which focuses on past prices. There's quantitative analysis, which focuses on analyzing the relationship between different quantitative variables. And then there's fundamental analysis, which is my own approach of understanding the underlying business. And within fundamental analysis, there are different styles as well. I do generally tilt towards value investing, which is trying to buy a great company at a great price. But there's also growth investing, which I do hold some growth companies where you pay out a little bit more, but they have a larger potential to grow their profits into the future. This video will be divided into chapters so you can skip between different sections. I'll try to provide alternative tools to the paid ones I use at work, and I'll also throw up a few terms and whatever on screen so that you can have something to reference later on. And for the purpose of saving time, I won't try to define every individual metric that comes up, and we'll generally, like mentioned, keep things high level. So with that out of the way, let's jump into it. The first step, as you'd imagine, is screening for ideas and finding the stock that you want to research. The whole research process takes quite a long time. It has taken weeks at times, but obviously you want to narrow down your list of potential stocks so you don't waste your time doing this whole process only to find that you don't really care for the company. Now, screening isn't necessarily a formal process. I do sometimes just research a stock because I want to, or there's been an interest in recent development, but I do have a screener that I regularly refer to. A screener lets you filter the universe of stocks so that you only have a list of companies that meet certain criteria. I generally keep it pretty broad, but we'll look for things like revenue growth, being profitable, as well as keeping debt within a certain range. From there, I'll typically put the tickers through an internal tool list of companies that meet certain criteria. I generally keep it pretty broad, but we'll look for things like revenue growth, being profitable, as well as keeping debt within a certain range. From there, I'll typically put the tickers through an internal tool that summarizes all their key financial information onto a one-page summary, not to make any decision off of, but again, just to get a quick overview of how healthy or unhealthy the company is and whether it's something I want to look into. Covering things like past financial performance, expected consensus estimates moving forward, their debt levels, a bunch of details, just again, summarize on page to see if there's anything of interest here. Now, once I have the company that I do decide I want to do this deep dive into, the second step is understanding the business. Makes sense. I know that sounds obvious, but as an investor, you really are a part business owner, so I do try to take the mindset of understanding the ins and outs of the company in the same way I might if I were to buy a private practice, and that means understanding all the company segments and what they do, how they earn their money, the nature of the company's revenues and whether they're contractual, recurring, or seasonal, where the company operates in terms of geography, customers, suppliers, employees, regulators, management, anyone that plays a role in how this company will perform, and depending on which sector the company operates within, also make note of their key performance indicators or KPIs, which again are kind of sector specific, allow you to compare companies that are within the same sector, but also requires a bit of industry background information. And there are times where I don't research a company because I don't yet have that familiarity with the industry it operates within. You do have to operate, as mentioned many times by others, within your circle of competence where you feel comfortable. Now, this part is mostly qualitative. There will be, say, quantitative figures that come up, but a lot of it is again just understanding the details of the operations, what this company does. So where does someone find all this information? Well, outside of a Google search, which is not a bad idea to give you an overview of the company, a good idea is to start with the annual report or 10K in the US, as well as the most recent quarterly report if that doesn't also apply to the 10K, all of which you can find on Edgar in the US, Cedar here in Canada, or the company's investor relations page, because they do a good overview of the company's business, the risks applicable, and key financial information. From there, I like to go through investor reports and recent 8K filings, which provide important updates about the business. And I do have access to a lot of paid for research, which I'll typically go through the external analysts' reports on this company. I also might look up commercials, tutorials, customer reviews, find any information I can about them. Now, as you expect, that's a lot of detail, so I do type notes as I'm going. I do typically categorize stuff under the SWOT framework, which is strengths, weaknesses, opportunities, and threats. Strengths and weaknesses are internal factors for the company. Opportunities and threats are external factors, and that just lets me quickly categorize stuff. I'll also write questions that I want to get to later. If there's something I don't understand or a risk that I thought of that I want to look into, I kind of do a parking lot of ideas that I want to go back and research at a later point. And my goal for all this is trying to find quality companies that have a competitive advantage, an attractive business model, and as Warren Buffett likes to put it, a moat, something that sort of protects them from competition. All right, so once we understand the business, the next step is understanding the finances, where we get into the numbers. Obviously, this is very number heavy and does require an accounting background to understand the different segments that you look at. Generally,
Basic
the
accounting.
company's financial position in terms of debt, how solvent they are, their capital structure, and whether they can meet the payments, the company's growth profile, their profitability, and again, where they have areas for improvement. A lot of this, as you would imagine, does really boil down to analyzing the financial statements, the income statement, which tells you how the company performed in the given year in terms of accounting earnings, the balance sheet, the snapshot of what the company owns and what they own, cash flow statement, the income statement, which shows you where cash is actually moving within the business, not just accounting earnings and accounting costs, where money was actually spent and earned. Now, I typically start by calculating a bunch of cumulative average growth rates, which I'll throw out the formula for, but I'll do this formula over a 5, 10, or 15-year period to get an idea of what the average growth rate over these periods are for revenues and profit measures. I also really like common size financial statements where you put everything as a percentage of a key figure. So for the income statement, that's revenue. For the balance sheet, that's total assets. And this is a great way to look from year to year to see what costs are getting bigger, which ones are getting smaller relative to the amount of total money that the company is earning. Then I'll calculate a bunch of margins and ratios that again give that profile about how the company is growing, how profitable they are, and different operational solvency, liquidity things that tell me the general state of affairs.
Pretty cash flow compression. Um, Free cash flow conversion. Free cash flow divided by EBITDA. The hell? Turns operating profit into cash.
A sort of peer analysis, comparing this company to ones in a similar space, based primarily off of these financial details, as well as the key performance indicators found earlier. And I have at times pivoted to a new idea based on this peer comparison because something else looked more attractive once I really got down to the numbers. Now, throughout this whole process and earlier with the overview of the business, I do carry out a check for red flags. Call it forensic analysis. In understanding the business, I want to know what related party transactions are, how management is compensated, any conflicts of interest, and in terms of finances, any accounting shenanigans. Unfortunately, you can't always rely on the figures as they're reported. Companies do at times fudge the numbers. For example, it's really common for management to highlight what's called an adjusted figure, which is where they take an accounting figure but then make some changes to it so that's more representative of what they believe the company has done. It's not to say that that's always nefarious, but it's really important to look into what the definition of that adjusted figure is and what they're adding or taking out the specific metrics that you want to look into. I made a crazy amount of use out of Excel templates and programs that pull data terminal information. And one of our sort of proprietary things, for example, is a peer comparison scorecard, where based on the industry, there are different metrics that are populated. You compare companies at a very high level.
Nggak pakai kayak
look
apa
on
namanya?
KPIs, compliances, all
Fucking
that stuff. So I'll include them for alternatives. I can't really vouch for many of them, but I have heard of them. And if you're relying on a source for data, make sure you understand how the data is pulled, whether it's aggregated, whether they make any adjustments to it, because it makes it really important when trying to research a company is being able to rely on the data. All right, step 4. Staying longer than I expected, but step 4 is understanding the strategy. Everything we've done so far is a sort of historical perspective on things. At this point, I want to know what the opportunity moving forward is. This includes going over the strategic priorities of management, as well as where they plan to spend money, what the capital expenditures moving forward will be. Capital expenditures, I don't think I've talked about, but found in the cash flow statement, and covers the money the company is investing in itself. I also want to know how they'll be financing
PPE.
so I'll consider whether they're taking on more debt or issuing shares or hybrid instruments.
I saw from financing the company that money
What I'm looking for is to evaluate its. So I'll consider whether they're taking on more debt or issuing shares or hybrid instruments, which get a little complicated. Regardless of what the plan is, what I'm looking for is to evaluate its feasibility, the risks involved, and the company's track record for doing what they say they will do moving forward. I've seen a lot of companies fail by doing something that they have no experience in doing. So it helps when a company, if they are a serial acquirer where they buy a bunch of businesses, it helps when they have history of doing that successfully and growing the company as a result, actually optimizing the companies that they bring in. Under
like if they do different things suddenly,
when they aren't actually improving their business. One way you can evaluate the track record is by looking at the 5, 10, 15-year average or some variation thereof of ROI figures, which includes return on capital employed, return on invested capital, and return on equity, among others. Those are ones that I like to look at. And you can do a qualitative review of management as well in terms of their experience or tenure with the business. One of the things I found really helpful myself as an analyst, as a quick tip, is building out a checklist of things you want to explicitly look for. And this is a checklist that you build out as you research companies and you think of things that you want to look for when trying to determine what the mode is, whether they're a healthy business, all this stuff. I have my own checklist that I built over time. Just an example of one thing on there is whether the company adds value for all the stakeholders, or are there any stakeholders outside of competition that will lose from operations and that will present a risk to the business's success. In terms of where you can find information about the strategy for the firm, you can typically find it in those regulatory filings. The 10K will typically have some sort of high-level strategic objective for the business. But you can also look at investor presentations, which again will highlight it. And transcripts from earnings calls are great because management is often asked questions about what they expect to do moving forward and the challenges they expect. You might also find transcripts from the different conferences management have gone to, which you again might be able to find on the investor relations page. And also through my company, I've been able to meet executives and have calls and attend in-person meetings with executives from different companies. In terms of researching the industry, again, I do have some paid-for services which really help. I do really rely on the data terminal as well as some expert inputs and news sources. But in terms of news, that's actually a good thing that most people can access is just researching news about the industry. You might be able to find some different research stats about total addressable market and whether things are growing or contracting. So once I understand the business, I understand their finances, and I understand their strategy, from there I'll look at the actual valuation for the stock. It's something I leave later on into the process because I don't want my earlier steps to be influenced by whether the stock is expensive or cheap, even though that is important. There are a number of methods for doing this. At a high level, there's relative valuation, which is looking at multiples, things like the price to earnings multiple, EV to EBITDA, free cash flow yield, things like that, which you can compare historically to what it's been in the past, as well as to peers to see what related companies or companies in the same industry are trading at, to see whether you're above, more expensive, or below that level. The more detailed approach is an absolute valuation, such as a discounted cash flow, which I do from time to time for companies where you actually forecast all the line items of different financial statements to more expensive or below that level. The more detailed approach is an absolute valuation, such as a discounted cash flow, which I do from time to time for companies where you actually forecast all the line items of different financial statements to forecast their free cash flow into the future, discounted to today's price, so that you have an idea of what you should pay today for that future performance. I like to change the variables to see how the company's stock price would be in different circumstances and what's justified in terms of the stock's price. I'll also consider the more current events around the stock, recent lawsuits, current headlines, press releases, which you can again find on the company's website, and I'll try to understand what variables in this realm are influencing the current stock price, as it tends to be the more recent stuff that sways prices in the short term. It doesn't matter much as a long-term investor, but it does help with the entry point. And I do consider some technical aspects of the stock more qualitatively, things like whether management is buying or not. But really, at this point, if I like the company and I think the valuation is attractive relative to what it could potentially earn, then I'll likely be investing at this step. Now, the problem is that stocks that have gone through all the previous sort of filters and steps at this point tend to be the most expensive. The stocks that have great growth track records, great profitability, excellent management, all that perfect stuff, they tend to be more expensive because investors recognize that and they bid up the stock price accordingly. If the company is not attractively valued, it isn't all for naught. At this point, I will simply move it to a watch list, at which point I will monitor it. I've already done the fundamental research and will have more flexibility to hop into the stock if there's a dip in the price given a current event. I can quickly analyze the current event, see if it's material or not, and then take advantage of any movements in the stock price. I will also dollar cost average in companies I really like, and generally speaking, that's a sound strategy for diversified investors, but I always have an eye on valuation. Paying too much for a stock does increase your risk of capital impairment, so I at least want to ensure that the price I'm paying is within a reasonable range. So that's the valuation step. And finally, step 6, we made it this far, is to review and finalize notes for future reference. At this point, I'll have an idea of whether I want to buy the stock now or wait, but I will also seek answers to fill in the gaps, address those questions that came up throughout the research process. I'll also try to play devil's advocate and find conflicting reports about, say, the thesis I've sort of developed with this company, find opposing opinions to try and sanity check some of my assumptions. I also have the benefit of being able to then share it with my team who have more experience with researching stocks than myself. And I typically write up a formal report, but will still organize my notes regardless, just so that they're easier to digest in the future. Making sure things are bullet points, providing a sort of summary that I can quickly reference in the future so I can get up to speed about my company and the thesis I have for it, and also points I want to follow up on. And the reason why I think this step is really important is not only because when a stock's on your watch list, you can quickly review things and get back up to speed with the company, but when times get tough and say something negative develops about the business that a lot of people are spooked is going to challenge their future performance, you can go back and see what the fundamental business is and what you believe the value lies in, what your thesis about the company is, and that'll make make it easier to evaluate whether that has fundamentally changed or if this new development is just noise that you can generally ignore and focus again on the long-term prospects of the business you've invested in. So that's my investment research process as an analyst. We made it. Thank you for sticking to the end. I know I didn't really get into all the nitty-gritty about the specific things I look at, but that is really out of respect for my employer. They were gracious enough to let me do this video. They don't have the perfect private patty secret formula, but they do have proprietary stuff that it's in their interest to keep. As I've hopefully highlighted, this is an ongoing process once you've found a stock, and especially once you've invested in it, to keep researching the company, not to get caught up in the day-to-day happenings, but to regularly review it and make sure you're not missing anything. And before I sign off, I do want to give a quick thank you to our sponsor.
Yeah, you don't have any.
Keeping up to date on news is an important part of the research process. I've always had to keep an eye on outlets to try and get an idea of the important headlines for the day. But if you want a free resource for keeping a pulse on the general markets and what's happening, are you reading Morning Brew? You can click the link in the description below.
Okay. Cool idea. I think that's it. I don't want to study anymore. Materi sama aja anjing kayak pertemuan. So yeah, tomorrow I'm gonna look at slide 4A. We'll see if there's anything else. I think that's it. Okay, that's